Hello everyone, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and finance presenter and columnist at the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder advocate.
And we are the Money Café.
That's correct, Alan, that's correct. Now, rare earths.
Rare earths, it's all
Donald
about rare
Trump,
earths at the moment.
Oh, incredible. Now, you on the news last night, I thought you did a fantastic job articulating and summarising Australia's rare earths position and the various projects in play with the Donald.
Yes, well, there were two projects that have actually got money in last night's announcement, or not last night's, the night before announcement. It's Arafura's Nolan's project in the Northern Territory, which is just north of Alice Springs, and Alcoa's attempt to get gallium out of its alumina refinery in Wagerup, south of Perth, which it's doing in partnership with a Japanese company called Sojitz. So gallium it does not exist on its own in nature. It's only as a byproduct of bauxite or iron. So you've got to get it out of the bauxite, and so that's the plan in Wagerup. Now, but it is worth noting that the announcements about money were only from money from the Australian government. There's no money yet from the US government. They're talking a big game, the US and Trump, as usual, but actually nothing has materialised yet.
Well, it's a bit like the Zelensky deal originally, wasn't it? It was give us all your rare earths and we'll give you some protection from the Russians. And then Zelensky wouldn't sort of hand over the crown jewels, and then they came back with something a bit vaguer. But certainly in terms of leverage and a pressure point of what the Americans want, they're very vulnerable to the Chinese stranglehold over rare earths, and very keen to build a global supply chain to neutralise that. So hence the magnificent Australian dowry in virtually all metals and commodities. But of course, we've got one of the great global dowries of rare earths. And so Albo had great cards to play when he went into the Oval Office there.
Yes. Well, and Donald Trump said, in 12 months we're going to have so much rare earths we won't know what to do with it. And that, of course, is incorrect. It's going to take ages to make any kind of dent into China's dominance of rare earths. And by the way, China has a dominant market share of rare earths because the United States let it. I mean, the US had the world's only mine for decades called Mountain Pass in California, just east of Los Angeles, and they basically closed down. They closed the mine in 2002 because China was undercutting them. So the thing was losing money, and also they had a toxic spill. But they could have, if the government had been smart about it, they could have kept it open, but they did not. The mine's since reopened. It's now producing, that mine in California is now producing 15% of world supplies, but it used to be 70%, and now China's got 70%. And so it's a real problem for America. But on the other hand, and I'm doing this for as a follow-up for the ABC for Sunday, I mean, the key point in the agreement that was signed by Albanese and Trump is, if you have a look at it, you can find it online. There's a paragraph talking about pricing, and what they're saying is that they're going to be floor prices. So the thing is that China dumps rare earths. The reason it's got dominance is because it undercuts everybody else, undercut Mountain Pass, and the product is cheap. So the way that America's going to win back some share with Australia of rare earths is by raising the price.
Yeah, guaranteed purchases.
That's right.
You basically underwrite future production.
That's right. So what basically is going to happen is the price goes up. That's what's going to happen. Mm. The price of rare earths is going to go up a lot in order to facilitate new mines in not just Australia but also America and elsewhere, in order to take market share off to China. Well, and guess who's going to pay the higher prices? We are. I mean, it's basically just going to be an increase in price. and the winners are going to be the companies. So this is why the share price of these companies are going up, because the investors understand that they're going to make tons of money out of this because their prices are going to be guaranteed.
Well, this is where I find it interesting that Albo can strike a deal, a national deal with deposits virtually in every state. I mean, there's even one up in near Swan Hill in Victoria. So these deposits are actually owned by the states. People forget that. It's owned by the state. So effectively, Albo had to round up every single state and the Northern Territory and say, we're going to put on a map, we're going to pledge this state-owned asset. And of course, then it's also privately owned in terms of there's a license to a mining company to explore and potentially develop. So you've got three players. You've got the owner of the resource, the state, the federal government doing the deal with Trump, and then the private, listed, often foreign, mining company explorer, which has pegged out the land and is looking forward and is pumping up their share price with all sorts of promises. So hence a lot of share prices are bubbling up, in my view, ridiculously on the whole blue sky of endless underwritten American cash to fund our purchase of rare earths, and it's quite a gold rush on the stock market. We're seeing things bubbling up, doubling, tripling, quadrupling. A lot of it will crash to zero. Some of it will crash to zero, and obviously some projects will get up. But it's a very, very heightened time for sort of share market punting, FOMO, YOLO. If you don't want to miss out, you only live once. You got to buy this stock, and up she goes. So it's an amazing time. But we are lucky as a country because we've got the resources, and the world needs it. Well, the Americans need it. They come to Australia, so hence Albo gets probably the best rails run into the White House of any leader in the world. Went beautifully a couple of days ago.
That's right, because Trump and America need Australia's rare earths, that's for sure. But Albanese hasn't pledged these rare earths. He's not in a position to pledge them. All he can do is say we're going to put money into them, which he's doing. He's giving Arafura, or he's going to buy. What he's doing actually, the Australian government is buying a share of these projects. So he said we're going to put 100 million US or 153 million Aussie into Arafura's Nolan's rare earth project in Northern Territory, and that's going to be for equity, right? So they're going to actually own part of it. What they don't say, and presumably I don't know whether they know or not, but they certainly don't say what share 100 million US buys you.
Well, that's right. It all comes down to price. And the mining industry is full of joint ventures. There's all sorts of, Mitsubishi has 13.6% of this iron ore mine and 27.5% of that iron ore mine. So you can buy equity in the project, you can buy shares in the company, or in the case of Iluka, which is one of the world's biggest listed mineral sands companies, they've received hundreds of millions of dollars of loans from the federal government to get their particular WA project up, which is deemed to have a lot of national security issues. So there's many ways to skin the cat in terms of how you support the development of a project, be it loans, be it equity, be it joint ventures, et cetera, and then Australian government, US government, Japanese underwritten. A lot of moving parts as you put together the funding package to spend literally many, many billions of dollars developing a suite of rare earth mines. And then you get to the whole issue of the processing and all the environmental challenges of where the processing is done. That's a whole new thing. In Linus's case, sure, they can dig the stuff up at Mount Weld in WA, but a lot of the controversial, environmentally challenging processing side of that company's done out in Malaysia, where it's been a hugely controversial issue for a long time. And that's where, a very complicated thing to build this supply chain, manage the environmentals, and it's all going to happen over 10, 15, 20 years. It's a long, long game that we're playing here, and we're right at the start in a very, very speculative, excited bubble.
Yes. Malaysia is not that happy about Linus's doing its processing in Malaysia. But I think they might be happy now. They've been whinging about it for ages because it's so environmentally, as you say, challenging. Because processing these rare earths throws off a whole lot of toxic carcinogens, which obviously China hasn't worried about. And that's part of the reason it's able to dominate the industry, because it's not concerned about environmental issues. But Malaysia's been worried about it, and now I imagine they're not worried about it because it's all it's all hot. And Malaysia is a bigger producer of rare earths than Australia, and is in fact, I think, the second biggest producer as a country, the second biggest in the world. Producer of rare earths. So that's good for Malaysia now because it's so bloody hot.
Yes, so it's a very exciting time. But look, overall...
Did you see gold? Speaking of excitement, did you see gold fell 6% last night?
Yes, and quant's coming off, uranium's coming off, silver's coming off. So, yeah, look, but they've only given back a small proportion of the gain. But I heard an interesting point yesterday that this is the first ever bull market in history, equity bull market in history, where gold has outperformed. Because normally gold, the oil crisis of 79, gold is where you go in a crisis. So it's the ultimate hedge. But this time it's partying, like it's 1999, like it's partying with everybody else.
That's right. So that tells you that gold is increasing as a speculation, not as a safe haven. And the other thing that's going on with gold is central banks are buying it to replace US dollars. And so they've now, in central bank foreign exchange reserves, now gold exceeds US treasuries.
Yes.
For the first time. Now, so there's two sorts of buying going on. There's central banks, which is that a safe haven bet? I don't know. It's just
central banks certainly after the Ukraine invasion and then the American use of
that's right
locking up 300 billion of Russian money in US dollars. That led to the central banks ditching the Aussie and going for gold. Then you've had the whole ETF thing now. So the biggest buyers of gold at the moment is ETFs, and that ties into the queues in Martin Place of people queuing up to get physical gold. So it's pulling buyers at all levels, and hence it's increased 12-fold on the stupid price that our Reserve Bank sold 2/3 of its gold at 1996. But can it keep going, Alan? I mean, 6% correction overnight, that's a bit of a warning sign, isn't it? That we might have hit the top.
Well, the thing about speculation and speculative manias, as this with gold is, it's got nothing to do with rationality or, the valuation of anything. It's just kind of momentum, and, nobody knows how long it goes. That's the issue. No, nobody's got any idea, and it's impossible to tell. I mean, the gold could go to $6,000, $7,000 an ounce. Who knows? I mean, it's not worth its current price. Gold makes no sense as an investment. It doesn't ever return you a dividend or anything. It makes absolutely no sense. So at $4,000, it makes no sense. So why shouldn't it be $7,000 or $8,000? Because
But lots of things are making no sense, Alan, like the AI bubble. I mean, I think maybe you and I and InvestSMART, I think we should launch a rare earths AI gold ETF. I mean, just put those three things in the name, call it an ETF, away you go, baby. So,
well, AI, no, hang on. AI, we've got a question about this, so we won't preempt that, but AI is making, or the AI companies are making tons of money. I mean, so there is some sense.
Well, no, not enough to justify the CapEx. So the incremental profit revenue based on the CapEx isn't justified by big tech companies already making a pile of cash, not particularly anything to do with AI, just their traditional dominance in their space. And then we're bolting on AI with a literally trillions CapEx program where I'm yet to see anyone who can point to the revenues and profits that will flow from that CapEx that will justify that from a return on investment point of view. But the share prices are pricing for blue sky. Hence, you can say it looks like an AI bubble as well, because anything with AI in the name is also, just like gold, rare earths, they're all rocketing.
Did you see my piece in the ABC on Monday about this?
I'm going to lie and say I missed it. You need to tell me and the listeners all about it, Alan.
Okay, well, the headline, the first paragraph said that if AI and crypto, but mainly AI, is not a bubble, we're in trouble. Because if the investment, if the prices of AI companies are justified, that means that all these AI companies are going to make a whole lot of money, and the way they make money, or part of the way they make money, is by replacing human beings. And so if it's not a bubble and it doesn't crash because all the CapEx is a good investment, that means that a whole lot of human beings are going to be replaced, not just some. And so I think it's a really interesting situation we're in now, whereby, I mean, I think it's fair to say it's a bubble, but it may be a bubble that doesn't crash.
Yeah, I mean, I agree that on the user side, for the efficiency side, for the corporates using it, but there's also a consumer side. If we're all suddenly paying $1,000 a year for our Microsoft subscription because we're all so addicted to Copilot that we can't function without it, then there's also the consumer prices to rise to use this product is the other side of the revenue stream, as well as the cost save for the companies replacing humans. But Apple shares are back at a record. They continue to persuade people to pay $700-800 for a new iPhone every 3 or 4 years. So, big tech's ability to get the consumer to pay more and more they've got a proven track record at that. Plus, they can deliver the efficiency gains, arguably AI, to all their corporate customers. So, you're right. It could still be justified, but I don't know. I'm still a bit of a skeptic.
Oh, well, I'm just saying that if it is justified, that'll be worse than a crash. That's all I'm saying.
From a human employment labour point of view, yes. Look,
Amazon.
I
there's a story in the New York Times this morning saying that Amazon plans to replace more than 500,000 jobs with robots. I mean, that's just one company. Amazon's going to replace 500,000 jobs with robots. My goodness, according to the New York Times. I mean, it's not an announcement, but they've they've got some internal documents saying that. So look, if it's 10 to 15% permanent unemployment, and it's not a recession, because usually that you get 10 to 15% unemployment in a recession, and the government and the central bank can deal with that by cutting interest rates and increase spending, because that's just monetary policy and fiscal policy. That's what you do. But if there's 15% unemployment in a productivity boom, then they won't be able to do anything about it. Mm. And so, I mean, a lot of people are now predicting 15% unemployment as a result of AI. Well, I think that is civilization changing. I mean, what is that? That has to lead to a complete rethink of the way welfare works, because they won't be able to deal with it with monetary policy and fiscal policy. Anyway,
it's actually one of my favourite AGM.
That was my piece in the on the ABC website on Monday.
I will go and read it straight after today's 6 AGMs, Alan. Now it's actually one of my favourite AGM questions this season is the AI question. Will you have less full-time equivalent staff at next year's AGM? What are the biggest productivity opportunities from AI, and how energetically are you pursuing those opportunities? So a nice little open-ended question for them to identify the hotspots of adaptation and adoption, and to talk about how aggressively they're chasing it. And most of them say, we think the numbers will stay about the same. But yes, we certainly are leaning in. We're certainly chasing it in, call centres and this and that and wherever. But I'm yet to have yes, we lost 5% of the workforce this year and another 10% will go in the coming year. So people aren't
no company is going to be honest about it. They're going to say we're doing AI. It's going to be great. No one's going to lose their job. Aren't we just wonderful people? I mean, honestly. But speaking of AGMs, how many are you doing?
Oh, look. Well, I mean, I did 5 yesterday. There'll be another 4 or 5 today. I'm looking forward to Sigma Pharmaceutical this afternoon. Actually, I'm going to turn up in person to catch up with the Chemist Warehouse billionaires. But look, I mean, yesterday Cleanaway was pretty interesting. They got a 40% protest vote on their remuneration report because they've had a number of fatalities, and the CEO's pay was only cut by $500,000. He's still got $4.2 million. So, bang!
They've had fatalities. Cleanaway's had a number of fatalities.
Yeah. Multiple over the last few years, and they don't announce it. Best practice with a fatality is stock exchange announcement.
But how are people dying?
Oh, just at the landfill sites, hit by rubbish trucks, accidents, with the big cranes and things, and moving gear around in the big landfill centres, that sort of stuff. So, yeah, look, it's bad. But particularly the industry funds with their union connection, they have got a very strong culture linking bonuses to safety. It's a really good thing. So if you have any form of safety issue, and particularly a fatality, if the board doesn't cut the CEO's pay and bonus significantly, you will see what happened at Cleanaway yesterday, which is a 40.7% strike against the remuneration report and 17% against the re-election of the chair of the remuneration committee, Jackie MacArthur. So so that was pretty interesting. And I was a bit disappointed I went to the Region Group AGM yesterday. They own like 150 shopping centres. They were spun off by Woolworths. It was all the Woolworths supermarkets. And someone got up at the meeting in Sydney and said, what are we doing with tobacco and illegal tobacco? And the CEO says, look, we've got 72 tobacco stores, across our network. But look, we don't really control it much. It's up to the police and the health authorities. And then the shareholders sort of saying, well, hang on a minute, you're the landlord, aren't you going in there mystery shopping? Oh, no, look, it's a bit hard. It's a bit hard to move a tenant on. You can't really control it. No, it's just a matter for the police, really, and the health authorities. And then he said, we don't really haven't had much contact from the authorities either. So
and this is to see whether his tenants are selling illegal tobacco.
Yeah. Whereas I would have thought it would be, we've done a whole range of mystery shopping. We've terminated the leases of 18, that we found them selling.
All they care about is the rent, mate.
Correct. So I was disappointed with that. But the good thing that happened there, I had a really bad day yesterday with a number of chairs refusing to say what the proxy advisors had recommended or whether there'd been any protest votes. Whereas for me, it's a standard question. Did any of the proxy advisors recommend against? And if so, has there been any big protest votes and what was the issue? And, at Bendigo Bank, at MyState in Tasmania, you get this stern lecture about, it's confidential. It's a private matter between these private proxy advisors and their institutional clients, and we can't talk about that. Now, that is absolute, pardon the language, that's crap. I've heard it discussed 100 times. So we had best practice at Region Group where I said, hey, 10% protest vote on the REM, what's going on? And the chair, Steve Crane, came back with the perfect answer, which was, we've had a disagreement with the proxy advisor, Ownership Matters. Our CEO is retiring in a year's time. Ownership Matters said that we should pro-rata his long-term incentive grant and only give him 1/3 of the grant because it's a 3-year grant and he'll only be here for the first year. We said, listen, Ownership Matters, you're telling us to cut the pay of our CEO to use board discretion. He's done a great job. It's his last year. We disagree with you. Hence, 18% protest vote against the grant, the incentive grant to the outgoing CEO, Anthony Mellows. That is perfect AGM practice. That is actually telling the great unwashed retail shareholders who've got no idea what the proxy advisors and the big institutions are doing. It gets explained to you at the meeting. That is what the AGM should be. It's basically an election outcome announcement event, and you have the votes shown, and then if there's been a big protest, you say, what's going on? Cleanaway was hopeless. I said, what's going on? And they wouldn't even say, we've had all these fatalities and this proxy advisor recommended against. They just said, the votes are the votes. And that's that. And then I said, why aren't you following the agenda, Cleanaway? Because you've just done questions as one job lot. Are you trying to reduce focus on the remuneration report so we don't have a specific debate on that? And the chairman says, we run the meeting as we run the meeting, mate. So I found them rather recalcitrant on good AGM practice. But I'm happy if you wins, Alan. I've got Stockland and ARB Group this year for the first time to release the proxy votes early to the ASX so you can debate them, and then to release the data on how many individual shareholders voted for and against each item. And that's great because you can see that the turnout rate has crashed to about 2%, and you can see retail shareholder voting sentiment when you get that data. So good progress on that front.
Well, thank goodness for you, Stephen Fairnickham. Well done is all I can say. Pat on the back to Stephen Mayne.
And just one last funny thing. So I've lobbed about 15 board tilts. I've had 2 or 3 rejected on the argument that an email nomination is not deemed to have arrived until the next day under our constitution. But the funniest thing is this, Alan, is I put my phone number, and I've had the same mobile number for 30 years. I put the number in my nomination letter, and I say, please ring me if you've got any issues. I've had one phone call. Guess who was it from?
No idea.
Jerry Harvey. So Jerry rings me up, gives me a gobful.
He rang you personally?
He rang me up, gave me a gobful, and then we ended up doing rare earth share tips for about half an hour, and we were going for an hour. We're going for an hour on the phone, and it got to 3 o'clock. And eventually, I had to end the call. Said, "Look, Jerry, it's almost 4 o'clock, mate. You got to get back and go and punt a few more rare earth shares so you can try and make more money than Gina. I've got to go and buy a few more shares so I can run for a few more boards of dodgy Perth-based companies that don't have hybrid AGMs." So, look, it's been a great hour. Look, we won't fight too much at the meeting. I'm running. I'll lose. And thanks for the call, mate. Have a good day.
Oh, that's very funny.
Yes. So.
Okay, well, we better move to questions. We've got so many questions, we can't possibly answer them all, for which we are sorry in advance. But still, before we go to the questions, here's a quick word from our sponsor.
Looking for an investment that aims for long-term growth with an ethical edge? The Intelligent Investor Ethical Share Fund could be the right fit for you. It's built for investors seeking to grow wealth through ethical, high-quality companies in Australia and overseas. A great option if you value long-term growth with purpose. The fund has delivered strong returns, showing that ethics and performance can go hand in hand, though, as always, past performance isn't a guarantee of future returns. And right now, you can invest with zero brokerage fees directly through Intelligent Investor. But hurry, the offer closes on Friday, October 24. Head to offer.intelligentinvestor.com.au/INES to read the offer conditions and see if the fund's right for you.
Okay, Phil is the first question. The chart Alan put up on ABC News on Wednesday night showing the correlation between Trump's 100% tariff call, China call, and his subsequent chickening out and the slumping of the price of the Trump family's World Liberty Financial seemed to demonstrate a Trump vulnerability apart from his vanity, money. While bond market vigilantes may discipline Trump as the need arises, could it be that Trump is vulnerable to personal discipline by investors shorting World Liberty Financial and other entities associated with the Trump regime? Well, I'm not. Yes.
Yes,
I
I agree. That's where the majority. He's obviously monetized the office to the tune of billions, and the crypto plays have been the most lucrative part of that, and that's as evidenced in the share price or trading price on Binance of World Liberty Financial, the Trump family main vehicle. And it did crash the other week when he said something stupid on China, and then he quickly tried to put that one back in the box and calm it all down, and the price recovered. So, yes, I mean, people initially thought he'd be sensitive to the share market, but with the tariffs back in April, it was like he didn't seem to mind for a while. Then he talked about the bond markets getting yippy. So he was sensitive when the US dollar and US bond yields started blowing out on tariff fears. But, seems that I think that's right. World Liberty Financial. If the price goes down, Trump might undo whatever has sent the price down because he's a very rich man and he's getting richer by the day in office.
Yeah, so World Liberty Financial's token price fell 32%. And the thing is that the S&P 500, after Trump threatened a 100% tariff on China, the S&P 500 fell 2.5%. World Liberty Financial fell 32%. Trump family was down 1.6 billion at that point. And he quickly turned around, and it wouldn't have been the S&P 500 that caused that to happen. So, yes, I think that the guardrails on Trump are, to be honest, probably more cryptocurrencies than the stock market.
Imagine if we were talking about Albo or ScoMo in those terms, you know.
I know.
Oh, ScoMo's, he's got rid of the lockdowns because his share price was down 200% because the lockdowns are hurting his personal wealth. I mean, this is what we're talking about here. It's so corrupt. Anyway, Matt says, last week you said that the share market is an earnings bubble, not a price bubble. What makes you think this? If we are in a bubble, is it not a similar situation to the dot-com bubble, which was fundamentally a price bubble?
Well,
what do you reckon, Alan?
Well, so the thing is that in early 2000, the NASDAQ PE ratio was famously 100 times. It's now 50 times, which is high. And the S&P 500, the broad market PE ratio, price earnings ratio, is less than 30. It's around 28, I think. So the thing is that the market is not overpriced, astronomically. It's a little bit overpriced against current earnings, and certainly nothing like what it was before the crash in 2000. So,
but there's pockets of bubbles, I think, will be the argument. Like the uranium bubble, the rare earths bubble, maybe gold, because there's no earnings on gold. So what's the PE on a gold holding? There's no E.
I'm not saying that there are no price bubbles. Of course, that's right. I mean, I saw a graph yesterday, which I'm going to put into the weekend briefing on Saturday, showing that the companies that don't make any money have been outperforming companies that do make money. There's someone's produced a graph showing the prices of companies that don't make any money, and which I thought was great. But look, there's definitely a price bubble. But I suppose I'm just saying that the question with AI, and in particular, is whether the earnings can be sustained. And because at the moment the earnings are coming largely from investment in getting ready for making money. I mean, it's the capital expenditure on AI infrastructure, and the question, and that's producing the current earnings, most of the current earnings. There's no real money being made that much on AI itself. And so the question is whether that's going to happen, whether these companies are going to make money from selling AI. And I think the jury's out on that. I mean, I don't know.
Well, Jerry Harvey was telling me that the US chip makers and tech companies all think Harvey Norman is the best retailer in the world for the way they have incorporated AI attractions into their selling campaigns and the way they're handling their stock to sort of upgrade your gear to get the best AI-enabled automatic vacuum cleaner, which is now doing 100 million a year for Jerry when 3 years ago it was zero. So, all those chips, are being embedded into, the robotics side of it, be it the no human vacuum cleaner, plus obviously the large language models and inference and everything else. So,
Joe says, are there any financial products, e.g. options, REITs, futures, synthetic, real, linked to the average house price in Australia? If not, can someone please make one? Then let us punters buy it. Might sound risky, but I think it'll be the opposite. Look, I mean, the answer is no, there's not.
Yeah, there's not, because the problem is for ETFs and things, you generally need to, the promoter of the ETF needs to be able to buy the physical product, buy the gold, buy the stocks on the market. And the reason why Australia can't have institutional corporate residential property ownership is that they would cop the land tax, because all the states have, Victoria the worst, punitive levels of land tax for corporates, but everyone's private home or private residence or your first property is exempt. So this is a tax barrier for corporate or institutional ownership of residential, and to set up some sort of ETF on Australian residential property, you would need to actually hold the stock. Whereas Australian property ETFs are incredibly popular worldwide, which is why many of the big property stocks on the market, from Goodman to Scentre Group, Vicinity, GPT, more than 20% of them is owned by the big index funds, because so many people around the world tick the box, yes, I want to buy Australian property, but sadly, because of that tax problem, actual existing family homes and residences just aren't in that investment equation, even though, Alan, you keep saying we've got to stop treating family homes as an investment.
Yes, that's right. Well, actually, there is a product. It's called the Rodwell Index, RODWELL. So if you want to Google that, you'll find it. And it's been launched by Evan Thornley, who has a company called Longview, and he's doing it in order mainly for superannuation funds to invest in real estate. But he's got this Rodwell thing. I mean, I don't know much about it.
Yeah, I was at his 60th a few months ago, and he was talking about his little small corner of the funds management industry. You're right. So he is.
So did he bail you up, and tell you, get you in a corner and tell you about this?
Oh,
No.
well, he's been doing it for quite a few years, yeah. So, but yeah, he certainly it did need some sort of tax preferred element to it because of those punitive tax things. But yeah, he's been plugging away for quite a few years, trying to come up with a product reflecting residential investment for Australian super funds.
Yeah.
But as he called it, it's still a very boutique sort of small corner of the funds management game. Now, Richard says shares in DGL were suspended on October 1 for non-lodgement of its accounts. The ASX has since advised continued suspension, although it's all somewhat vague. Do the ASX eventually have the power to specify a time frame? What else can you tell us about the situation? Well, Richard, you're right. DGL is this New Zealand-based, controlled by this rich lister guy called Simon Henry, chemical company. So it's, it does $500 million a year in revenues. But you're right, it was suspended on October 1 because the auditor, PKF, disclaimed its opinion on the accounts. It wouldn't say the accounts are true and fair. It wasn't comfortable with them, and they were having big blues with the board about a couple of things. One was to do with the stock take on a couple of their chemical sites. The other one was the ability of management to override certain financial controls in the accounting system. And so, game on. Auditor versus board. Auditor won't sign off. ASX has automatic suspension if you haven't got signed audited accounts. And they're bluing. So,
So what is and DGL's holding out? Are they? They're just saying.
Yeah, well, they're saying we believe that they're wrong. And the claimed net assets is 341 million. Yet the market cap before suspension was 158. So that says to me, where's your $200 million write-down? The market doesn't believe you, board. And the board's coming out saying, EBITDA, EBITDA profit forecasts looking good. When I think they just need to be taking a big write-down and doing what the auditor says. But you've got a pugnacious rich lister as the controlling shareholder. He's going, you're wrong, auditor. And the auditor's saying, well, we're not signing. And the ASX says, no sign, no trade. So
next step, new auditor.
New order. That's right. That's right. I reckon ASIC should be appointing auditors, and ASIC's KPI should be the more blues you have with the company, the more gigs we'll give you.
Yeah, right.
But as soon as you get the boards choosing the auditor, you get a risk of conflict of interest and complicity.
Yes, indeed. Auditor shopping, they call it.
Auditor shopping, that's right. So,
okay, Kristen says, my partner and I are both regular podcast listeners. We're getting married this Saturday, and ahead of the wedding, I'm wondering if either of you have any advice on how to approach money and spending as a couple. Are there any overarching principles that have served you both well when it comes to making money-related decisions within your marriages? Well, what a good question, Christian. Stephen, have you got any advice for Christian?
Oh, look, I think consult. Outline the delegations. Who's got the spending delegations? Budgets are great. I would definitely encourage budgets. Transparency, equality of competence. So if one member of the marriage is not particularly strong financially, put the time in. Listen to the Money Café. Whatever you want to do, train yourself up. And but yeah, you're right. It's very different to investing because the biggest level of conflict is the spending question. How big a forever house do we buy? How much do we invest in the kids on the school fees? Can we afford the holiday? So the trade-off negotiations on allocation of capital in a marriage is probably the thing which is tricky. And I would just say, be transparent, always consult. But who's got the veto power in a two-person board is interesting because two's not an odd number. So 1-1, who's got the deadlock vote? And that's a power dynamic within a marriage. And every marriage is unique in that regard.
I think the fundamental question to be asked and answered is, are you going to have separate accounts or not? Are you going to merge? Are you going to have a joint account where all your money is in together? Or are you going to have a joint account and separate accounts that you have your own little spending money? And, I mean, some couples do both. I mean, I think either one is valid, but the way I've run my marriage is we've had all the money together. We've not had separate accounts. And the one thing with that you've got to watch is whether you're both So there needs to be a common understanding of what the aim is. What are you trying to achieve with money? Are you saving for something? Are you not saving? How much have you got? You both need to know how much you've got in there all the time, and that if you both know how much money you got, and you both know and agree on the strategy, what you're trying to achieve, then there shouldn't be any conflict, because it's obvious what you need to do in terms of spending. That's all I'd say.
Well said, boss. Now, Anonymous on good governance asks, that I mentioned in a recent episode, that one can run for boards of public companies simply by being a shareholder and nominating themselves to the company. I'd assume that one needed to complete an AICD director's course, which runs at about 10K. Is this big board spreading misinformation, or am I missing something? Well, no, Anonymous, you don't have to do the director's course. You can be a 97-year-old homeless person and you can run, who doesn't even speak English, or, whatever. There is no limitation on who can run. A couple of boards have been trying to make me do bankruptcy tests, and I just say, no, I'm not doing anything. You just say it's a contingent nomination. You just say that if the shareholders vote for this clown, the board reserves the right to do due diligence and test and all that sort of stuff. So, look, it's very easy. I don't want to encourage too many people to do it, because then they might take the right away. But and of course, it is good to have done the AICD course. I did it. Manningham Ratepayers spent probably $10,000 training me up to do that course 15 years ago, maybe. We've got probably the best director training system in the world, the AICD, because the company's part. There are hundreds and hundreds of local government councillors who've done the AICD course at 10K funded by the ratepayers. So it's very, very well embedded in the training. And I've done it. So I just say, yeah, I've got the director's ticket to ride. But you don't have to have that to run for the board of BHP. You just got to buy a share and send in your nomination, and away you go. So, Alan, I'm waiting for you to run for your first board. So easy, before you retire.
Oh, no thanks. Christ, imagine if you won. Jesus. No thanks.
Yes.
I'll leave that to you, Stephen.
Thanks, boss. Your turn.
Another anonymous question. Could inequality in Australia be helped by significantly increasing the current New South Wales premium land tax from 2% on land worth over 6.6 million to, say, 10%? Perhaps the threshold for over 1.07 million could be increased as well. I'd suggest this is done in single houses only, i.e. not apartment buildings or strata blocks. Yes, well...
No, look, I'm not a fan of differential property taxes, because it shouldn't just be on land, it should be on buildings as well. It should be on capital improved value, and it should be based on a percentage of what the whole property is worth. But there are so many exemptions, farm rates and exemptions from land tax. And basically the states, particularly Victoria and New South Wales, are already absolutely creaming, particularly commercial property owners outside of the family home, absolutely creaming them on stamp duties, land taxes, COVID levies, fire services levies, all sorts of things. So I don't think we need to do any more hitting of property owners in the general tax mix in Australia. You'd far be better going after the iron ore miners and the gold miners and the people who are paying tiny royalties, rather than over clubbing the commercial property owners. What do you reckon, boss?
Well, there's a bloke called 100 years ago. A bloke called Henry George suggested that we really should just tax land, and I do think there's a case for that, to moving to land taxes. After Henry George died, there was the Henry George League started up around the world, really, and tried to continue his work, his advocacy for land taxes. And these days, that the Henry George League is called Prosper Australia. So it's worth looking on the Prosper Australia website and reading what they put out. It's kind of interesting. They don't just advocate land taxes now; they're much broader in their advocacy, which is good. They're terrific people, I think. So look, I do think there's a good case for land taxes as a way of governments raising money, because they are a way of reducing inequality and taxing people with lots of property.
Anyway, go on. No, I think that's. I agree with you. It's a good point. Now we do have a related real estate question from James, basically saying when you go to an auction or when a property is sold, should the agents and the owner of the property be obliged to make public what the reserve price is? So
Well,
what
he doesn't
their
say
selling price is.
The questioner doesn't say the reserve. He's saying they should be required to advertise a home as a minimum sale price, which I suppose is the same thing.
Yes.
But, the reserve is slightly more formal. I mean, I think it's an interesting question, but I think it's unrealistic to say that when the house is put on the market at the beginning, they say what the reserve or sale price, minimum sale price is.
Yeah, because it is sort of government intruding into private treaty, isn't it? I mean, if private people want to negotiate a sale, I mean, who is the government to say the person who starts with the asset must make a public announcement as to their minimum price? You know, you need a bit of flexibility.
Well, yeah, but the thing is, at the start of a campaign, when the house first comes on the market, I don't think the agent or anyone knows really what they're going to get, and they want some flexibility during the course of the campaign to figure it out, to see what people say as they come through the house, and they get an idea from talking to people what it should be. But I do think the reserve should be published before the auction, perhaps the day before or 2 days before, something like that, because I think it's really wrong for people to show up to an auction without knowing what the reserve is. I think that it's reasonable to publish the reserve immediately, because one day before the auction, the agent, everyone, the people know what the house they want for the house at that point, and they're just withholding it to give themselves more power at the auction.
Yeah. Okay, so if that was a rule just for the auction, the public auction method, then you could probably justify it, but it's not currently the law, and I don't think it applies anywhere. So it's interesting. Now let's do one more, Alan. We'll do Luke. I found this video on YouTube this week summarising the money changing hands between mega tech firms, OpenAI, NVIDIA, Oracle, etc., as quote round tripping to falsely inflate their revenues. What do you think of this? Is this legitimate? It seems to have GFC written all over it. So the circularity of payments between all of these big tech companies, Alan, it certainly is round tripping, which has an implication of dodginess where you're creating a false perception through money starting somewhere, doing a round trip and finishing up where it started. And that actually is happening, albeit there may be real business models within that round tripping process by the biggest gorillas we've ever seen in corporate history.
Yes, well, after that, those announcements from OpenAI, which was a flurry over a few days, a couple of weeks ago, I wrote a piece in the weekend briefing saying that it all looks a bit like a Ponzi scheme, where they're kind of just where new money is holding up the returns for old money, and it is the case, I think, that customers, NVIDIA's customers, and OpenAI's customers are beginning to finance the purchases by those companies from the customers. I mean, there is round tripping going on, but it's not all of it. I mean, there's still, but what I think is more Ponzi-ish about it is that all this is basically holding up the US economy. I mean, the capex in AI in the past 12 months has represented 92% of the US economy. And it's also holding up the share market. So the spending on AI is actually holding up the ability of these companies to raise money by holding up the economy and the stock market. So without the spending on AI, the stock market would be much lower, and they wouldn't be able to raise money to do the spending. And I think that there is a Ponzi-ish characterization to what's going on as a result of that, as well as the round tripping of the money.
Yes, but most of the biggest players are not having to raise money. I mean, yes, Intel, 10% US government, and obviously OpenAI. And that's, for me, that's the problem child, because it's not listed. There isn't transparency, and it is burning cash. It desperately needs to raise money. So, but as for, NVIDIA, Microsoft, Amazon, the other big boys, they're not raising equity capital because they're the world's richest, strongest, they've got the best balance sheets ever. So there's not a pile of debt that's going to be left by those companies. They're all good for the spending they're promising. But OpenAI, I think that's the problem child, and I'd like to see that become a public company, because it is at the centre of all the round tripping, with its $1 trillion plus US dollars, that is, of various deals with all the other big players in their big happy circle.
I must say, I don't know about you, but I love ChatGPT. I think it's great. I use it. I'm using it every day, quite often. It's fantastic.
And you're probably, I think 20 million people are paying for it and 360 million are freeloading. I think you're probably in the not yet paying, or...
I'm paying for it, but I just find it so useful. And what gets me is, I'll ask it a question and it'll answer it quickly and it'll engage with me, right? So I can, I then engage in a conversation with ChatGPT. But I'm aware that at the same time as I'm doing that, there's millions of people doing the same thing around the world. So it's like, when I'm engaging with ChatGPT, it feels like I'm the only one. But actually,
everyone's doing it. Yes,
everyone's doing it at once.
Yeah,
and
but you know what?
And each person is being treated by ChatGPT as if they are the only ones.
Yes, but you know what the unsustainable thing is? It's the videos. It's the fake videos, because the compute that's needed to produce those fake videos is ridiculous, and people are never going to pay the real cost of that. So I reckon you're going to see quite a clampdown, not just Martin Luther King's family saying, hey, stop letting people desecrate, the legendary Martin Luther King with these dodgy AI videos. But I think so that will have to be cut. But just chatting, making you feel special. Alan Kohler's got a big loving relationship with ChatGPT, surely here. Gee whiz, tell them to take an ad, Alan. That was quite an effusive endorsement you just gave there.
Oh, that's true. Oh, well.
It's just you being honest, though. You're not getting any money
for
it.
For that. OpenAI did not pay for that. No. That's right.
Now, boss, I've got the Fletcher Building AGM to get to, so I reckon we're over and out.
Okay, very good. Have good luck with your AGMs today, and thanks everyone for listening to Money Cafe. I'll be back next week with James Thompson. Send in your question to the moneycafe@eurekareport.com.au, and we'll try to get to it. Sorry we didn't get to all our questions today, but there's just too many. I'm Alan Kohler, founder of Eureka Report, finance presenter and columnist for the ABC.
And I'm Stephen Mayne, and we'll see you in a fortnight.